everybody. Welcome to the Monthly Market Insight. This is February, the first Monday of February. So welcome, happy 2024. Sean's going to go through a lot of great things on this webinar today. We're going to go through kind of what the numbers are in terms of what the Fed is saying and inflation and jobs report and in interest rates and things like that, how that impacts the market. We'll take a look at how 2022, 2023 performance, looking at 2024, and kind of going through some of the updates and changes we made to our portfolio and why. So Sean, I'll let you take it from here.
Yeah, thanks, Nora. So it is, again, another volatile year, but so far we've kind of got back to some new normalcy in terms of highs and things like that. So we will start by kind of going over our monthly market insight and looking at what's happened so far year to date. So what we can see here is the black line, we've got the Dow Jones Industrial Average. The light blue line, we have the S&P 500, a little bit better barometer of how the overall U.S. markets are doing. In the green, we've got the NASDAQ index, more of our tech and our growth-based companies. And in the purple, we've got kind of the companies outside of the U.S., so an international index in there. So what we can see is so far for the year, right, markets are doing pretty well. We've got the S&P up about 3.7%, the NASDAQ's up 4%. The Dow Jones is up 2.6, and the international market is still down about 1.7. So the markets so far for the year are trending in the right direction, which are really, really good things, positive overall. Some of the things that have caused that to happen is really started back in November, December. The market started to get some really good momentum. So we saw, if we looked from 2023 throughout kind of current year to date, we saw the markets really pick up towards November, December timeframe, and that momentum has kind of kept going in January. So what's happened? So what we've seen is inflation started to come down, especially in December. We've got a really, really good inflation report where inflation, the consumer price index, CPI, went from 3.6 to 3.1. So we saw the markets bounce back. That combined with kind of some slower than average job growth going to close out 2023 led to the markets doing really well. Well, this month, just last week, we got a jobs report that said we added 363,000 new jobs, which drastically outperformed kind of what people were expecting. And unemployment remained at 3.7%. So why is that important? That's important because the Fed then came out shortly after and said we don't plan on lowering rates just yet. We're going to keep them where they're at around that 5.25 to 5.5%. So the Fed did not announce that they plan on lowering rates. So we saw a little bit of a pullback in January until we got the jobs report, and then the market kind of took off again. So what we're seeing is the Fed saying, hey, we don't expect to lower rates just yet, but right now we've got inflation kind of coming down. That being said, the January consumer price index, we actually saw an increase. So we're going to get the next consumer price index inflation number that comes out on February 13th, which is going to give us a much better picture of what's going on. Do we see inflation coming down, or is inflation kind of continue to rise just like it did in January? That's going to be the start to see, do the markets continue to go, or do we see a pullback? Ultimately, the markets are looking for unemployment to go up above 3.7. I would say above 4%, we might start to see the Fed start to say, all right, we're going to start to lower interest rates. But coming out of November, December 2023, the market thought the Fed was going to lower rates. People were expecting a lower rate in March, but maybe by the summer. With the recent reports that have come out, no one's really expecting that anymore. And the Fed kind of reiterated that in January with their remarks that said we plan on leaving it flat, don't expect it to happen in March. So again, we kind of still have the same data coming out. Unemployment, the markets want to see it go up a little bit to say, hey, there's some pain in the economy. Therefore, the Fed will lower rates so long as inflation comes down. Those continue to be the two different data points that we look at on a continual basis. All in all, though, 2023 was a phenomenal year, and so far we're off to a really, really good start in 2024. What we were telling clients in 2022 was stay patient, right? We had a market high on December 31st, 2021, and then we saw the markets pull back, and that was as we saw rapid inflation kicking off. Did my screen drop out there? There we go. So there it is. So we saw rapid inflation, and really what that led to was the Fed raising interest rates. The combination of those two things we saw all the different markets trending down, and that included the bond market. And that came all the way down through 2023. And then we started to see the markets bounce back in 2023. And they've continued to carry on really strongly in November, December 2023 and into 2024. So we had market highs of the S&P 500 there in light blue again. We have beat that market high again. So what we were telling clients during 2022 is stay patient. I know it's not fun. It was a really, really long drawdown in the market before we saw another market high. It almost went 2 full years before we reached that market high, but we reached it. And every time there's been a market high, there's always been another market high. So staying patient, trusting your portfolio, it will deliver the results in due time. And that's exactly what's happened. The NASDAQ, again, slightly down still from its last market high. The Dow Jones has been up. And then international is still down about 10% from the end of 2021. So international hasn't been performing as well. A lot of that is because there's a lot more different countries with their own Federal Reserve policy and statements and interest rates that they're manipulating that's not going to be directly correlated to the U.S. market, how our Fed is operating. So that's kind of how the markets have gone from 2022, 2023, again, a great year, and then 2024, so far off to a good start. Cautiously optimistic, depending on what happens with Consumer Price Index this month on February 13th. We still have unemployment remaining really low at 3.7%. The markets want to see that tick up. That number comes out at the beginning of March next month. So those are the things that we're really watching closely right now. The good news is if we do have unemployment, that means consumers have jobs. When consumers have jobs, they spend money. 2/3 of our economy is based on consumer spending. So we still have a strong fundamental economic kind of base underneath us. We just keep watching some of these macroeconomic data points come out with unemployment and inflation, and that's what we'll continue to monitor moving forward, especially through this first quarter. But don't expect the Fed to lower rates anytime soon. One thing that we've learned through all this is the Fed is not able to predict 30 to 60 days out. They keep changing their tune based on the way the data comes out. So certainly we can't, you can't, speculators can't. What we're going to do is buy a really, really solid portfolio, stick to the plan, and watch time take care of the markets continuing to rise. Speaking of that, some things that we're talking about with our clients throughout this first quarter, taxes, developing a good solid tax strategy, making sure people have funded their IRAs, doing backdoor Roth IRAs, things like that. 2024, we saw a little bit of an increase due to some of that inflation. So IRA contribution amounts ticked up to $7,000 with a $1,000 catch-up. 401ks went from 22.5 in 23 all the way up to 23,000 in 2024. The catch-up contribution amounts remain the same, but make sure you're updating your contributions with your employer or in your own IRA so that you're maxing those out for 2024. We're also meeting with our clients doing estate planning. Always a good time to just go back and review your beneficiaries. Make sure those are all up to date. Develop an estate plan, wills, powers of attorney, trust documents. And then one of the changes for 2024, the gift limit went up to $18,000 per beneficiary. So you can gift away that amount. Again, you can always gift away more, but if you gift away more, then you have to start filing a gift tax return, and that can get tedious to follow. The gift tax, estate tax exclusion went up to $13.61 million per person, or as a family, $27 million. Anything less than that will pass down to your heirs without taxes. So you can gift that money away and no one has to pay taxes on it. Just know if you gift away more than $18,000 per year to someone, you'll have to file a gift tax return. When we look at our portfolio, right, we made some changes in December. Mainly, one of the biggest changes we made is we kind of shaded away from some international, and that's because it's really been a drag on the portfolio, which I'll kind of go into. But kind of our current portfolio, right, if you go back to 2010, again, past performance is not indicative of future results, right? Our portfolio is outpacing the S&P 500, the S&P 500 being in red, our portfolio being in blue. So that's always what we want to do, is make sure we're providing some alpha, if you will, or some a premium in return over what the S&P 500 or the market's doing in general. And I'll kind of go into how we're doing that. Our 60-40 portfolio, which would be 60% stocks, 40% bonds, again, outpacing what we would say is kind of Vanguard's balanced fund, a good barometer of a portfolio. That'd be 60-40, kind of a more moderate portfolio. Again, outperforming that. And with the way that we're able to do those things is by putting clients' money in low-cost, broad-based index funds, and then tilting that portfolio to certain asset classes that have a premium. By that, specifically, we have the NASDAQ index. If you go back to early 2000s, outperformed the S&P 500, and that's exactly why we have it in there. So we've got the NASDAQ in blue, the S&P 500 in yellow, and we have an international index there in red. And that's kind of what we're saying is we wanted to shade away from some international because we see it pulling down the portfolio's returns. It's underperforming the S&P 500. However, that doesn't mean it's necessarily right for everyone, right? There was an outperformance from 2000 really through about 2008 in international. That's because the US markets went through the tech bubble bursting. We had 9/11 kicking off, then ultimately the housing crash in 2008. So there is reason to say that they could be a good diversifier in the portfolio. What we've done is said we found other asset classes that can mitigate some of that risk. Specifically, we've added in healthcare as an asset class in our portfolio. Again, healthcare in blue outperformed the S&P 500. International dragging that down. We want to put money, our clients' money, in places that's going to provide a premium on return. And what we see is it actually has a better downside, right? So a smaller downside protection. So we get some diversification in that asset class by putting money in those low-cost index funds. Mid-cap value, and this is specifically what I'm talking about from 2000 through 2008. We can see kind of the mid-cap value hangs in there with international during kind of the volatility from the early 2000s with the NASDAQ and with the S&P 500. So we want to add asset classes that do provide that diversification from the S&P 500, but ultimately they're going to outperform it in the long term. So that's kind of how we're investing clients' money. Small cap value also going to be a big part of that portfolio. Again, those two asset classes outperform with kind of some uncorrelated returns. So those are the big changes that we made in our portfolio. Again, using extremely low-cost, broad-based index funds in order to achieve market premium for our clients. And that's how we're going to continue to invest as we navigate the unemployment rate, the consumer price index moving forward. And that's how we're able to deliver a premium return for our clients at an extremely low cost.
Appreciate it, Sean. We do have one question that came in, and it's really on tax strategy. So this person had asked, can they still contribute to their IRAs for 2023?
Yeah, great question. So for IRAs, you can technically file all the way up till tax filing date, which is April 15th of 2024. So you could still make your 2023 contribution all the way up till April 15th of 2024 for the tax year 2023. So yes, there is still time to put money in there for your 2023 IRA contributions.
Thank you. And then kind of parlaying that into, sometimes we get some questions from clients is it good to fund your IRA at the beginning of the year? Does it make sense, or is there a really big difference on that?
Yeah, so we really try not to get into timing the market. Right? I do not have a crystal ball. I'm not good at doing so. No one is. But if we look at probabilities, the market generally tends to be more positive than it does negative. So 4 out of 5 years history would show us the market's going to be positive. If you wanted to gamble, you could say, yes, if I put it in earlier, generally speaking, 80% of the time it's going to be better. When we look at the current market conditions, we don't try to get into the timing of doing so. We are hearing a lot of people talk about election, right? How is the election going to impact my portfolio? We are going to continue to talk about that in our monthly market insights throughout 2024 and use data to suggest that it's not going to matter. It will create volatility. It will create a lot of emotion, a lot of fear, a lot of people scared of change. But ultimately, the data is going to show it doesn't matter who's in office, Democrat, Republican, the incumbent, or a new president. It's just going to create volatility. But we always have to remember companies are going to find a way to provide value to their shareholders regardless of who's in office.
Awesome. All right, that's all the questions that came in. Appreciate everybody's time. Thank you, Sean, for going into detail on that. If you have any questions, send them over and we'll meet at the beginning of March.
Thanks, everyone.